Hold on to your portfolios, investors. The financial roller coaster isn't slowing down anytime soon. Wall Street experts are cautioning those eager dip buyers who swooped in after Friday's sharp plunge in American equities, hinting that rougher roads lie ahead, despite encouraging signals from China and the U.S. about reviving trade negotiations. Published on October 14th, 2025 at 9:30 a.m. UTC. The S&P 500 Index, a key benchmark tracking the performance of 500 large companies listed on stock exchanges in the United States. You can check its latest details at https://www.bloomberg.com/SPX, jumped by 1.6% on Monday. This bounce back recovered over half of the losses from Friday, which were sparked by renewed worries over trade tariffs. For newcomers to investing, dip buyers are essentially savvy traders or everyday folks who see a stock price drop as a bargain hunting opportunity, buying in with hopes of quick profits when prices rise again. It's like spotting a sale at your favorite store and loading up on items you know will sell out fast. But here's where it gets controversial. Market observers from top firms like Morgan Stanley, Evercore ISI, and JPMorgan Chase are predicting continued volatility, or what they call skittishness, in the near term. They're pointing to overvalued stocks as a ticking time bomb, compounded by the potential fallout from the U.S. government shutdown and the ongoing uncertainties in international trade. Lofty valuations, in simple terms, mean that share prices are already high relative to a company's earnings or assets, making them vulnerable to even minor bad news, like a sudden drop in consumer confidence or economic slowdown. Imagine building a house on shaky ground. It might stand for a while, but the next big tremor could bring it down. And this is the part most people miss. While the U.S. and China are showing willingness to talk trade, these experts argue that underlying issues such as tariff hikes or supply chain disruptions aren't magically resolved overnight. For instance, a government shutdown, when non-essential federal services grind to a halt due to budget disagreements, can ripple through the economy, delaying payments, halting investments, and even affecting consumer spending on everything from cars to groceries. It's like a traffic jam on a major highway. Even if one lane clears, the backup causes delays everywhere. Of course, not everyone agrees with this gloomy outlook. Some contrarian investors might argue that these warnings are just noise from cautious analysts who thrive on fear, and that the recent stock rebound proves the market's resilience. After all, history shows that dip buyers often profit when volatility subsides. But is this resilience sustainable? Or are we setting ourselves up for another painful correction? What are your thoughts? Do you see these cautions as prudent wisdom or overblown pessimism? Is the optimism around U.S.-China talks enough to weather the storm? Or will high valuations and political gridlock prove too much? Drop your opinions in the comments below. I'd love to hear if you're doubling down on those dips or steering clear altogether.